China has announced tariffs on US imports, including crude oil, coal, and other goods, to come into effect next Monday. Trump says the tariffs are punishment for Beijing's failure to stop fentanyl smuggling into the US.
We're talking about a tariff of 10% on China based on the fact that they're sending fentanyl to Mexico and Canada. Mexico and China, we're talking about approximately 25%.
Over 180 vessels and insurance companies further tightening restrictions on Russian oil exports.
What if Russia's most crucial economic lifeline is being methodically severed by its supposed strongest ally? Behind the scenes of diplomatic handshakes and public declarations of friendship, China has been quietly executing a strategic retreat from Russian oil markets that threatens to destabilize Moscow's wartime economy. Since Western sanctions first hit Russia following its invasion of Ukraine, China positioned itself as Moscow's economic savior. But a dramatic shift is now underway. Chinese state refiners Sinopec and Zhenhua Oil suspended Russian crude purchases in March 2025, despite Beijing's continued rhetoric about their limitless friendship with Moscow. This calculated pullback represents a seismic disruption to Russia's export strategy, considering Chinese purchases previously accounted for approximately 42% of Russia's seaborne crude exports. China's strategic reduction of Russian oil imports. The scale of this relationship cannot be overstated. In 2023 alone, China saved approximately $10 billion by purchasing sanctioned oil from Russia and Iran at steep discounts. This created an alternative market that effectively bypassed Western financial systems while providing Russia with the revenue stream it desperately needed to fund its military operations. China's pragmatic approach to this relationship was never ideological. It was purely transactional, designed to secure energy resources at bargain prices while expanding its geopolitical influence. This lucrative trade operated through shadow market mechanisms that evaded Western scrutiny. Chinese refiners made payments in yuan rather than dollars, circumventing the US-dominated financial system. Meanwhile, a fleet of tankers operating outside maritime regulations transported millions of barrels of Russian crude across the world's oceans, establishing an alternative energy supply chain beyond Western control. However, recent Western sanctions have fundamentally altered China's risk calculation. Chinese refiners now find themselves reassessing their relationship with Russian oil suppliers as the threat of secondary sanctions looms larger. The potential economic consequences of continuing to purchase Russian crude at previous volumes have become too significant to ignore. Major Chinese financial institutions are particularly vulnerable to Western banking restrictions, with executives increasingly concerned about their access to international markets. The numbers tell a compelling story. Industry analysts report that approximately 900,000 barrels per day of Russian crude will suddenly lose its primary buyer as Chinese purchases continue to decline. This represents a revenue loss of roughly $27 billion annually for Moscow, a devastating blow to a wartime economy already struggling with inflation and military expenditures. Putin now faces the unenviable task of finding alternative markets for this massive volume of oil in a world where most major economies have already aligned with Western sanctions. China's retreat isn't happening due to ideological differences or diplomatic pressure. It's driven by cold economic calculus. Beijing has determined that the risk of secondary sanctions and potential isolation from Western markets far outweighs the benefits of maintaining its current level of Russian oil imports. This pragmatic self-interest reveals the limits of the much-touted Russia-China partnership when faced with the reality of global economic interdependence. What makes this situation particularly precarious for Moscow is the timing, occurring just as Russia's economy shows signs of severe strain from sustained Western pressure. The Kremlin's financial reserves, while substantial, cannot indefinitely absorb the shock of losing its largest petroleum customer. More concerning for Russian strategists is the realization that despite years of preparation for economic warfare with the West, they failed to anticipate their allies' willingness to prioritize its own economic interests. The secondary sanctions squeeze, how Western pressure points reached Beijing. The Kremlin's economic planners found themselves outmaneuvered not by direct confrontation, but through a strategic vulnerability they never adequately protected: their shadow fleet of oil tankers. When U.S. Treasury officials blacklisted 183 vessels carrying Russian crude in January 2025, they created an impossible dilemma for Chinese refiners that not even Beijing's considerable economic might could resolve. The question was no longer whether China would continue buying Russian oil, but how quickly it would retreat. This particular sanction succeeded where others had fallen short because it targeted the precise infrastructure that Russia had assembled to circumvent the G7's $60 price cap on its crude. Unlike previous measures that focused on financial transactions or specific individuals, this approach struck at the physical means of transport. The shadow fleet had become Russia's lifeline for delivering oil to Asian markets after Western carriers refused to handle Russian petroleum. The strategic brilliance of the U.S. approach lay in its precision. Rather than imposing broad sanctions that might have been difficult to enforce, Treasury officials meticulously identified and blacklisted the specific vessels transporting Russian crude. This shadow armada had moved over 530 million barrels of Russian oil in the previous year, with 300 million barrels, nearly 60% of the total, destined for Chinese ports. By targeting the vessels themselves, Washington effectively poisoned the entire supply chain. The sanctions were particularly devastating because they specifically targeted major Russian producers Gazprom Neft and Surgutneftegas. These companies formed the backbone of Russia's oil export capabilities, and their designation created cascading effects throughout the supply network. Chinese refiners suddenly faced an impossible choice: continue purchasing from these critical suppliers and risk devastating secondary sanctions, or sever ties with a major source of discounted oil. Global markets responded immediately to this strategic chokehold. Brent crude prices surged above $81 per barrel as traders anticipated significant disruptions in Russian supply chains. This price increase reflected a fundamental reassessment of Russia's ability to maintain its position as a major oil exporter when its primary transportation network had been compromised. Perhaps most remarkable was the speed with which these vessels transformed from valuable assets into toxic liabilities. These tankers, many worth upwards of $40 million each, became virtually worthless overnight. No legitimate insurer would cover them, no reputable port would receive them, and no company with significant international operations would risk association with them. With a single administrative action, Washington rendered billions of dollars in Russian maritime assets functionally useless.
For Chinese companies, this development forced a fundamental recalculation of risk. While Beijing had previously benefited from discounted Russian crude, the potential costs of secondary sanctions now far outweighed any price advantage. Chinese state enterprises, with their extensive global operations and dependence on international financial systems, couldn't afford to be cut off from Western markets and banking systems merely to maintain access to Russian oil.
What happens when a pragmatic economic superpower determines that the potential damage from Western sanctions outweighs the benefits of discounted Russian crude? The answer became clear as Chinese refiners began systematically disengaging from Russian suppliers. This wasn't a matter of political alignment, but pure economic self-interest. Chinese companies had witnessed firsthand the devastating impact of American sanctions on corporations from Iran, Venezuela, and even Russia itself. The shadow fleet failure, Russia's expensive maritime gamble. As Chinese refiners backed away, Russia's multi-billion-dollar shadow fleet of aging tankers transformed from ingenious sanctions workaround to maritime albatross. What seemed like a brilliant strategy, creating an alternative oil transportation network beyond Western control, has deteriorated into a logistical catastrophe that threatens the very foundation of Russia's wartime economy. The numbers tell a devastating story. Transport times for Russian oil reaching Chinese ports have increased sevenfold since January alone. Voyages that once took weeks now stretch into months, creating cascading delays throughout Russia's export infrastructure. These aren't merely inconvenient scheduling problems. They represent a fundamental breakdown in Russia's ability to deliver its primary export commodity to its most important remaining customer. The economic fallout has become impossible to conceal, even within Russia's tightly controlled information environment. In a telling sign of internal crisis, Gazprom CEO Alexei Miller has approved the layoff of 1,500 employees at the company's headquarters. This drastic workforce reduction reveals how severely revenue streams have contracted as the shadow fleet strategy unravels. For a state-owned enterprise that functions as both economic powerhouse and political instrument, such public contraction signals deeper troubles than Moscow would ever willingly acknowledge. What makes this shadow fleet particularly vulnerable is the compounding nature of its operational challenges. These vessels, many purchased at premium prices as Russia scrambled to build alternative export capacity, face a triple threat of maintenance issues, insurance gaps, and navigational restrictions. Many are decades old, requiring constant repairs that cannot be properly performed without access to international maritime service providers. Without legitimate insurance coverage, these ships navigate in a perpetual state of financial jeopardy, one accident away from environmental catastrophe and economic liability that no captain or shipowner can reasonably accept. The maritime strategy that seemed so promising when conceived has fundamental flaws that become more apparent with each passing month. Russia attempted to replicate Iran's sanctions evasion methods, which had proven relatively successful for Tehran. But this approach overlooked a critical distinction. Iran's economy is a fraction of Russia's size, with correspondingly smaller export volumes to manage. What works for moving limited quantities of Iranian crude simply cannot scale to accommodate Russia's massive production capacity. The $1.8 trillion Russian economy cannot function using the shadow market tactics of a much smaller, more isolated nation. Western intelligence agencies, meanwhile, have developed increasingly sophisticated methods for tracking these vessels despite attempts to operate dark. Satellite technology, commercial shipping data, and coordination among allied nations have created a surveillance net that makes these ships highly visible targets for sanctions enforcement. The very vessels designed to evade Western detection have paradoxically become some of the most closely monitored maritime assets in global shipping lanes. For China and other potential buyers, these challenges transform Russian crude from attractive discount opportunity to toxic liability. The combination of extended delivery times, questionable vessel safety, and heightened sanctions risk has fundamentally altered the risk-reward calculation. Even with steep price discounts, the operational complications have rendered much of Russia's seaborne exports commercially unviable for risk-averse international buyers. The painful irony for Moscow is that its expensive maritime workaround has evolved into yet another vulnerability. The hundreds of aging tankers acquired at inflated prices now represent billions in stranded capital that cannot be easily repurposed or sold. As Western sanctions continue targeting this infrastructure with increasing precision, Russia faces the prospect of a maritime fleet that costs more to maintain than it generates in revenue. The economic stranglehold on Russia has reached unprecedented levels, creating a perfect storm of financial pressure and strategic isolation. Unlike previous sanctions regimes, this new reality is defined by China's pragmatic retreat, effectively implementing Western restrictions more thoroughly than their architects could have hoped. This represents a fundamental shift in Russia's geopolitical position, as the Kremlin faces dwindling options for its critical revenue stream. Putin stands at a crossroads where economic realities overwhelm nationalist rhetoric. The mathematics of warfare are brutally simple. Diminished oil revenue directly impacts Russia's military sustainability. As President Zelensky observed, the less revenue Russia earns from oil, the sooner peace will be restored.
This financial pressure forces strategic reconsideration within the Kremlin. As economic lifelines constrict further, Moscow must eventually acknowledge its financially unsustainable course. The question is no longer if, but when.